Well, I'm the Chuck and the market's up, Chuck. And today we're going to look at the educational sectors. The blog said, we have a lot to learn. It's kind of interesting. One of the side effects of this recession with all the unemployment, as I mentioned in the blog, is that a lot of people are, going back and seeking to improve themselves through, attaining higher levels of education. So the industry has actually been a very strong sector throughout this, recession. I want to start by looking at a small education company, Capella Education, and it has a short record, about a 4-year record, as you can see. But I do want you to notice that the earnings growth of this company has been extraordinary. It has no debt in the balance sheet, and it's increased earnings from 89 cents to $1.39 to $1.71 to $2.27. That's a 35.7% growth rate, and that's also achieved, for the shareholders, about a 38% shareholder return during one of the worst economic periods we've had. Obviously, the 4 years from 2006 to 2009 have generally been very, very poor. As you can see by the S&P 500, it's actually been a negative 12.7%. So just another indicator that it's a market of stocks, not a stock market. This little company, it's obviously there's some risk here, but it's actually a very well capitalized, just under $1 billion market cap company with no debt on the balance sheet that's done very, very well, throughout this recession. Kind of moving up the food chain a little bit, we have Strayer Education, Inc., which is another company with no debt on the balance sheet. They have a 19% growth rate. They do pay a nice dividend yield, I might point out, that they instituted. But one thing about this stock that I do want to point out, the earnings growth has been exceptional. It's been very consistent. As you can see, the stock has held up very well during the recession. It did have an initial drop like most stocks did, but as you can see, has recovered very, very nicely. The track record of this company correlates very closely to its, operating history. Again, a 29% growth rate versus 3.3% in the S&P, because now we're looking at a 14-year history, which is approximately what this company has here. The one thing I want to point out, this company trades at a very high multiple, and even though it's in a hot sector and it's a hot company, I think I'd be very careful when I look at this. You're paying 32 times earnings for a company that is expected to grow at 20% a year or better, but you do have to rely on the market keeping the price-earnings ratio very high, in my view, at least, to make any money going forward. My third example is DeVry, and another college education company that offers various degrees for higher education for people that are aspiring, especially adults that are aspiring to improve their states. Not quite as good an earnings picture as the other, but I do want you to notice going through the recession, they've had really a very strong operating results, even though we've been in very challenging economic times. So if I focus in on just, the last, 4.5 years, 4.6 years or so, I want you to notice that the earnings growth has been very consistent. It's averaged over 22%, and they've generated a, equivalent rate of return for their shareholders. I do always want to emphasize how closely the operating results of the company correlate to the returns the shareholders, earn. Its earnings determine market price in the long run, and as you can see, there's no relationship to the market over the last 5 years. To DeVry. It's another company with no debt, that's held up very, very well in the recession, and has been, hot recently based on the fact that, the numbers these companies have been producing on an operating basis have been very excellent. And my final example is the Apollo Group, and as you can see, they did have one little earnings hiccup back here in, fiscal year 2003, but otherwise they've had very excellent operating results. Again, very little debt on the balance sheet. These companies are, very well capitalized, as I point out. Their business is very, very strong throughout this recession, and here we have a 28.5% grower that's generated a, 20% plus rate of return for shareholders. I did a 10-year performance here, 9.6 years, where the S&P has lost 4.1%. So again, no relationship at all to the market, no relationship to the general economy. But these companies have actually prospered when other companies have done very poorly. I'd kind of like to round today's presentation out with a little discussion of cash flow. Also, as you can see, Apollo Group generates very excellent free cash flow, has low debt on the balance sheet, as I already mentioned, trades at around 16 times earnings, and is forecast to grow at around 15% or better, by the consensus analysts following first call. I would say that from a standpoint of quality and long-term, this would be one of my favorite choices. I think Strayer is a great company that's probably overpriced today. I think Capella has a very high PE ratio for a young company, but it has the most, room to grow. So, look at these companies, and there might be something for you to take a further look at and do a little more research into for your own portfolio. This is Chuck Carnevale. So, we do have a lot to learn. This has been my pleasure. I thank you for listening, and talk to you again tomorrow.